If you're holding US Treasuries as a safe haven to stabilise your returns, they could be about to let you down right when you need them most. Treasuries, the most popular go-to asset in times of uncertainty, have done a disappointing job this year of dampening volatility in portfolios, and it's a risk that could be about to get bigger. So, where should you look for alternatives? Katie, you're a good person to talk to about this. You talk to big institutional investors every day. How worried are they about holding US government debt in their portfolios at the moment?
So they're certainly thinking about their options. When you buy treasuries, you want something that's predictable, you want something that's stable, you want something you know you can sort of forget about and know what it's going to do. You want something that's boring.
And they're not being boring at the moment.
Indeed not.
Hello, I'm Seb Morgan-Clark, and this is Fidelity Answers, the series where we take the questions that investors are asking and put them to the people who are managing their money. With me is Katie Roberts, who heads our global solutions team here at Fidelity. She works with a wide range of investors to help them build and balance their portfolios. Hello, Katie.
Hi, Seb.
So what is the question that investors are asking at the moment? What have you brought to the studio to us today?
So investors are looking at their bond holdings and thinking about, the way they've behaved in the past, that's what I want. And obviously what we see more recently is they're behaving quite differently. So where do investors go for those safe havens? Where do they go for their slightly more boring behaviours in portfolios?
So it's that sort of age-old metaphor, where are the ports in the storm?
Exactly.
And with us to help answer that question today are a couple of, shall I stretch the metaphor, sailors, captains, and probably safer to stick with portfolio managers. We have Mike Riddell, who invests in a range of global bond markets, and someone who's got a lot of skin in the game when it comes to credit and money markets, and that's Tim Foster. Welcome to you both.
Hi.
Mike, how are you feeling about public finances?
It's probably a slightly flippant question. I mean, not great, but I think it does deserve a slightly longer answer. That public finances obviously are under pressure. There's a huge amount of bond supply, and we'll get onto that and talk about what that means for treasuries and the shape of the yield curve. But I think there's another angle here, which is not just supply of bonds is huge, but demand for longer dated bonds has been waning, which is the other side, which is what's particularly scary.
Tim, same, different, better, worse?
I think, yes, it's obviously a bit of a leading question that you asked, but I think
you see right through
me. I think the thing I always try to remember as well is governments have plenty of tools to kind of control exactly how they're doing the supply, and also to encourage their citizens to buy that government bond supply. So I think governments have a lot of tools in their arsenal, and I'm perhaps a little bit more worried about the knock-on impact on other borrowers being sort of crowded out or something like this by this huge quantity of bond supply.
So, I mean, plenty to talk about there, but perhaps if we start with treasuries, as I said, they've had a lot thrown at them over the last few years with COVID, inflation, correlations. What's happened more recently since the tariff announcement?
If we zoom out, let's zoom out quite a bit first of all, and then kind of narrow in. And you're absolutely right, Katie. I guess we had a kind of pretty benign sort of 20-year period, really, up to and sort of including the first kind of couple of years of the pandemic, where government bonds in particular did a very good job of diversifying risky assets. That correlation between bond returns and equity returns was kind of firmly negative, really, from sort of about 2000 to about sort of 2021, something like that. And then that kind of changed with sort of 2022. That was a kind of watershed year, really, where we saw equities down sort of 20% and treasuries down about 10%. And that was really a consequence of the very high inflation that we saw. Government bonds hate inflation, and so that kind of high inflation kind of period after COVID was particularly tricky for government bonds, which I guess is now why everyone is sort of so sensitive to that correlation. And again, bringing it fast forward into this year. I think government bonds had a pretty good period really from sort of February, through to the first couple of days of April. Remember the sort of tariff talk kind of escalated, I suppose, in sort of about mid-February with some of the steel and aluminium tariffs. And actually, government bonds, Treasuries did a pretty good job. Equities sold off, and Treasuries probably rallied sort of 50 basis points in that sort of February to kind of early April period. So that was all pretty so far so good. So really, what's got people a little bit worried is really just a few days kind of in sort of mid-April.
And if you do take a rolling 1 year correlation, so we've looked at the correlation between the global aggregate index, that's basically every investment grade bond in the whole world, and global equities. And you have, as Tim said, there was this positive correlation as inflation soared. And we had, frankly, terrible returns from fixed income everywhere, where bonds went down and equities went down, and then equities went up at least, and then bonds still went down. And I think a lot of that was because bonds really were the return-free risk rather than the risk-free return in 2020. But the good news now is that yields are obviously much higher, but also correlations have changed. As Tim said, it's only been a few days where we've had some slightly worrying, positive correlations. But over a 1 year rolling correlation, the global aggregate index is now slightly negatively correlated with global equities. So yields are much bigger, and the correlations are doing what they should be doing, which fixed income now has got a place in multi-asset portfolios. I answered countless questions from people 2 or 3 years ago where they said fixed income is dead as a diversifier, and I think it was only dead as long as inflation was very high, but clearly that's, hopefully behind us.
Tim, thinking about where US Treasuries, the yields on them have gone, and also just thinking about the difference that we're seeing in spreads in credit markets, they've been behaving a little bit differently. There's a question floating around, are people actually almost as comfortable lending to companies now as they are to the US government? What's your view?
I think that's a sort of soundbite that sort of does crop up at times like this. I'd be very, very sceptical about that. It kind of comes back to my point earlier about governments have an awful lot of tools for sort of extracting taxes and from their citizens. So yes, it's very, very hard for me to people say, yes, Apple should be more secure than the US government. I can't really believe that. I don't think that can kind of possibly be true. Given the tools that the governments have.
It is possible, I suppose, for a corporate bond to have a lower yield than a government bond of similar maturity. You do see this sometimes in emerging markets, or maybe in Italy in 2011, where corporates can trade inside governments. But yeah, totally agree. With the Federal Reserve doing whatever it wants, frankly, to buy treasuries in a crisis, I think that seems unlikely for the case of the US.
And Tim, maybe the dollar's had a really tough time recently. Can you talk a little bit about that?
What has changed? I think a couple of things have changed, this year, and particularly with the sort of April and tariff episode. And one of those things is that the dollar has does seem to have had a sort of step change. The other thing which has changed is that kind of yield curves have sort of steepened, fairly steadily throughout this process. And I think that kind of comes onto some of the questions you asked right at the start. Points to basically lower demand, probably at the margin, or certainly the threat of lower demand for US assets, and a desire among holders of unhedged US dollar assets to perhaps start hedging those, and the yield curve point is similar, caution around demand for long dated dollar assets, really.
Okay, that's really helpful. So that's sort of where we are as a bit of a scene setter. But where are we going? Mike, we've got some big events coming up in the US policy calendar, from the end of the tariff amnesty to the final vote on the big and beautiful bill. What do you expect to see happen in markets over the next couple of months?
I think the first thing to say is I expect just something to happen, because actually markets, we touched on it, but markets are just... most markets anyway, outside the dollar and I guess oil prices during the Middle East conflict, but nothing's really moved. I mean, if you look at where everything's trading versus the beginning of the year, or say end of March when things really began to kick off, credit spreads are back to where they were, equities are similar level to where they started the year. Actually, longer dated bond yields are a bit higher, but shorter dated yields are a little bit lower as the market started pricing a few extra cuts. And yeah, exactly as you say, I think the focus has been entirely on the Middle East, and markets and investors are only really capable of focusing on one thing at a time, it seems. And the focus has been entirely on the Middle East and oil price and Iran and Israel and the US, and now hopefully that's mostly behind us. And the markets are now thinking, what's next? And this is absolutely what's next. So July the 9th, and I'm assuming in the run up to that, there's going to be a huge amount of volatility, noise, threats. And given where markets are priced right now, with, again, risk assets priced for perfection, credit spreads back at the near all-time highs, things are once again priced for perfection. And just anything, any news could cause a volatility spike. So, we've been moving more defensive on the back of that, because I think, exactly as you say, there's a lot that could happen, and nothing is really priced.
And what do you expect to see the dollar do as we get through these next few weeks?
It's been our view, and we talked about it on a podcast just a few months ago, but we are absolutely in the camp, which now is an uncomfortably large camp of people who are bearish dollar. I think a lot of the kind of active real money investors and hedge funds, I think, are definitely in this trade. It's a big consensus view among some parts of the market where everyone's talking down the dollar, and I think for very good reason. But Tim touched on it before, but it's the unhedged dollar exposure is now the big story. Where if you think about, again, zooming out, we have had a fall of maybe 6% in the dollar versus a basket of currencies that the US trades with since March. But that's nothing in the grand scheme of things. The dollar had rallied almost 40% from the lows in 2011. So we're coming from a position where, just on a kind of long-term fundamental view, the dollar looks incredibly expensive. And in January, I think, as I said a few months ago, it was as expensive on a trade-weighted basis as it had been since 1986. And it's not that far off those levels. So, the dollar looks very, very expensive. You then think about what's the policy response in the US, and clearly, Donald Trump wants to make the US more competitive. Now, you can debate whether he's going about it the right way, but weakening the dollar is perhaps a deliberate goal, but it's certainly a side effect of the policies that he's pursuing. So, we totally believe that the dollar is overvalued and it needs to weaken considerably. And we're talking about 20% just to get to the long-term averages, and these things do tend to mean revert with a lag as well, and with long leads. So. We're still very much in the dollar bear camp. And I think that, tariffs, assuming that these tariffs do happen, which is very likely in a few weeks, again, is going to renew focus on US growth prospects. The Fed, in response to weaker growth, as long as inflation is really just transitory, which seems most likely, the Fed can cut aggressively. We get a new Fed chair next year, don't forget. And that's another thing on the horizon, which markets haven't quite focused on yet. But the Fed chair is likely to be very dovish because that's what Donald Trump wants, and he ultimately is choosing who's going to be the Fed chair. So I think there are a lot of reasons to be very bearish dollar. One of those is not now positioning among the hedge fund community, but I think there are much bigger flows at play here, which is 10 or 11 years of hundreds and hundreds of billions of dollars of assets going into the US dollar, where these haven't been hedged, and people who didn't hedge are now getting very worried. I've actually anecdotally just had conversations with clients in the last few weeks, whether it's like Swiss private bank, London councils, all sorts of clients who are investing in US assets, and it has been unhedged, which has been a great trade, and they're all worried about it. So I think these flows are still to come.
And perhaps picking up on the hedging point, I know you've talked about hedging and how difficult it can be for some investors. So what if investors, is that something investors just need to pay a bit more attention to, or are there other things they can be thinking about?
I think one of the reasons it got so crowded was for many years it was an easy trade for investors to buy dollar assets and not unhedged, and that was kind of difficult thing to do anyway. So and you had positive correlation between the US economic performance and the dollar, so kind of everything was pointing in the same direction, and it worked very well for them. So I think that combination with the fact that it was kind of difficult for them to hedge anyway, just has led to a lot of unhedged positions which are looking a bit vulnerable.
I just want to come back to tariffs for a bit and think a little bit more about what impact we expect that to have. So specifically sort of the income from tariffs, maybe a question for you, Tim, because if we stick with this, just the 10% that is currently bedded in, no matter what maybe happens after the 9th, that's still a huge boost to US finances. Where does it go from
Yeah,
there?
it's an interesting question, and this is one aspect. It's kind of like it's a slightly, I think, undercovered aspect. It's kind of the counterpoint to, the fiscal easing that we are seeing. Obviously the big beautiful bill, it incorporates quite a bit of sort of fiscal easing in the first few years, and then a bit of sort of tightening, sort of in years sort of 4, 5, and 6, and further out. But yes, you've got to remember that tariffs. So that should be a boost to the U.S. consumer, but you've got to remember that tariffs are basically a tax on the US consumer. So, and early indications are actually the tariff, the sort of tax take to the US government from tariffs, is coming in quite high, actually, as far as we can tell. So, what should be a bit of a fiscal boost from the big beautiful bill, I think is going to be undone, actually, and could be more than undone, by the sort of tax on consumers that the tariffs are doing. But yeah, I think it's a bit uncovered. I think actually that's one sort of perhaps a bit uncovered, positive factor maybe for treasuries, for long end treasuries, is actually, the US government should be getting a decent amount of income from these tariffs. So, that could perhaps at the margin reduce a bit of that issuance need, at least in the short term. But yeah, definitely not good for sort of US growth, because it is a tax on US consumers and US businesses.
Mm-hmm. And Mike, talking about treasury yields, that they're high enough, people we expect are sort of buying, and that's going to help the dollar, right? That's going to stabilize things, we think, in the sort of near to medium term.
Yeah, there's a whole load of speculation a few months ago, when 2 months ago, but peak hysteria was like, the US is going bankrupt, and we had a similar issue in the UK, I guess, in 2022, where it isn't that no one's going to lend to you at any level. There is a level, and we just have to slowly get there. And I think that's what's been happening. You've seen it in the long end of the treasury market. It's very interesting. Going back to the question at the outset about safe havens on US Treasuries generally, different parts, fixed income generally, to start off with, just different parts of fixed income can behave in the complete opposite way of other parts of fixed income. So it is not homogenous in any way. But even the Treasury curve, the safe haven, I'd say 2-year or 5-year Treasury is a safe haven, because ultimately that's what drives that, is where the Fed is going to put rates. And if there's a US recession, they're not going to be hiking rates, they're going to be cutting rates. So I think it does behave as you want. But the longer end of the Treasury curve is clearly where the pain's been. And let's say in April 2024, if you thought there were going to be loads of rate cuts, if you'd bought a 30-year Treasury to reflect that view, it would have been a disaster, because actually yields have gone higher, even though you've been right. The Fed has cut by 1%, whereas 2-year or 5-year yields have moved lower. So yeah, on Treasuries, where could yields get to? It's difficult to say, because I think it is a little bit unhinged, and it really is driven by demand and supply, rather than the market's view of where Fed policy rate, or same for gilts, same for any global government bond market.
Yeah, and you mentioned gilts, and I know that there's been some comparisons drawn from various commentaries between what's happening in the US now and what happened in 2022 with the gilt market in the UK after the then Prime Minister Liz Truss's infamous mini budget. Are those comparisons fair, do you think, Tim? What lessons are there to take from that event to what's going on in the US at the moment?
There's certainly some similarities, and we talked at the start about caution from lack of lower demand than there used to be, and clearly that that's what was behind a lot of the experience in the UK. We had sort of, having had many years of structurally high demand from asset liability matchers. That demand's reduced over recent years, and that was a kind of big factor setting up that sort of problem. The UK does have a sort of number of kind of unique factors, and I'd sort of put the Bank of England's sort of quantitative tightening kind of program in that. The Bank of England's doing active sales of gilts, which the Fed are not doing. So there are some kind of uniquely more difficult factors than I think in the UK. But so there's an upcoming. If you asked earlier about things we're worried about in the next few months, in September we'll hear about the Bank of England's plans for quantitative tightening next year, and that's going to come into fairly sharp focus fairly soon, I think.
For me, actually, the biggest similarity between what's been happening in US Treasuries and the dollar and what happened in the UK actually is behaviour of bond yields and currencies. So, and I remember to the day looking at markets in the middle of August of 2022, where normally what drives currencies is rate differentials or yield differentials, because if US growth is great, the Fed hikes, the dollar goes up. That's normally what happens. And in the UK in August 2022, you had gilt yields rising, which normally means, relative to other markets, normally means sterling should be going up, but sterling was actually going down. And, as I've looked at emerging markets for many, many years, this is what you see when EMs are about to launch into a crisis. So I remember seeing this and thinking, this is really not good. And this is exactly what has been playing out in the US, not to the extent that we saw yet in September, October of 2022 in the UK, but we're absolutely seeing that pattern where Treasury yields are rising relative to other markets, but the dollar is weak. And to me, that is a huge warning sign.
It's just going back to tariffs, and we touched on the income from them, but there's been speculation about the inflationary impact of tariffs. Do you have a view on that, Tim? And maybe it's a time frame that we need to be thinking about that.
I'm kind of tentatively expecting the impact to be sort of more drawn out. It probably is a time frame thing, more drawn out than I think a lot of market commentators are going for. Particularly as they're so uncertain. I think the uncertainty of the whole thing. If you're an importer and you're sort of thinking, well, maybe the tariffs will be, maybe they'll be postponed, maybe they'll be delayed, maybe there'll be carve-outs. I think the uncertainty just encourages all participants in that supply chain to just kind of hang on a bit, and it sort of smears the sort of impact out over sort of several years, which is a little bit different from what the market is pricing. Market in terms of the inflation market is pricing a fairly sharp pick up, in inflation in the near term, but then also very sort of sharp, essentially all priced to go away again, between sort of years 1 and 2. So, for my money, I think it'll be, the impact that there is will be much more drawn out.
Yeah, markets are pricing in basically 3%. Last time I looked, 3% CPI in the US for the next 1 year, and then, as you say, from 1 year onwards, it's basically 2.3 to 2.4 forever. Right. So that is what's priced in. It's like it's literally a blip, and that's it. And I'd agree. I mean, obviously, July the 9th is the line in the sand, but we know that this can change, and you might have some countries a deal is agreed, some aren't, some delays. So I think it's going to be, as you say, a drawn out, staggered process, just because different countries and different industries are hit at different times, which is just going to make this a longer term process.
Keep the ball rolling.
Yeah.
Well, I think this might be a good time to start drawing some investment implications from what we've discussed. And Mike, you mentioned emerging markets. My colleague Patrick Graham has been talking to senior sovereign analyst Andressa Tezin a little bit more about why those regions are having a moment and where she's looking for yield.
Welcome, Andressa.
Thank you so much.
This year feels like a bit of a moment for emerging markets, finally, after quite a rough period. Is that right?
Yes. Well, we hope this year is the actually of emerging markets. We had definitely very bad 10 years in emerging markets with a lot of stories, lots of defaults. And finally, I think we are emerging here towards a better period where we're going to see better returns from emerging markets and therefore more inflows to emerging markets.
Okay, and why is that?
Yeah, that's mainly, I think, is because we are coming towards the end of this US exceptionalism. So you're seeing finally some interest rate differential in favor of EM. We are seeing the dollar weaker. We are seeing better returns coming into some other countries in emerging markets. I mean, we have Latin America showing a very decent return, either in stocks or in equities or especially on my field, which is fixed income in FX and rates. So there's a lot of positivity coming from emerging markets because we have better growth, better interest rates differential, and FX appreciation. So we have carry.
Okay, so that's the sort of big, broad picture development. But how about particular countries?
Definitely, yes. We are very much seeing Latin America because it was the first region to hike interest rates. So now we reach a certain point, especially Brazil, for example, if I can pinpoint some countries. Brazil is the first country actually that reached 15%. They just hike interest rates for one more time, and they said it would be the last one. And with that, you see that that's the moment you want to have carry. That's the moment you want to be in a country that is potentially the next move is going to be a cut rather than a hike. And so Brazil is one, definitely. So we like the currency. In terms of trade, it's positive for Brazil. We like the currency. We like the FX. In CE region, we quite like actually Hungary at this stage. We think the FX has still some momentum, mainly because we're seeing current account surplus in Hungary is 2% of GDP vis-a-vis other countries that are potentially can say that they have some momentum in terms of growth, which is the case of Poland. But the fiscal situation in Poland is much worse than the fiscal situation in Hungary. So we always need to look at this differential. So it's a fundamental, and you're looking at returns as well. So returns in Hungary are giving much more than returns in Poland at this stage.
Andressa, thanks very much. It's great to have you.
Thank you.
Patrick Graham there talking to Andressa Tazeen. So, Mike, Andressa highlighting all the opportunities, or at least some of the opportunities, but given the scale of the geopolitical shifts that we've seen in recent days, what are the risks when it comes to emerging markets now?
Although EM has done well this year, it is a completely has been an unloved asset class because of that dollar strength. Global capital's all flown to the US and in a lot of cases out of emerging markets after that bubble we had in EM from really, I guess, 2001 until about 2011. So, what will make that capital leave EM or go back to the US? What worries me the most, which is a potential risk, even if it's not my core scenario, is let's just say US inflation does come in much higher than people expect, and not just these tariffs are not transitory or some other factors push up US inflation. Maybe if the Fed then unexpectedly has to hike when actually there are quite a few cuts now priced in, that would probably push the dollar up, and that would be bad for emerging markets. So I think for me, that's probably the biggest risk. And then you get to individual countries, and there's always political risk. You saw what happened to Turkey in the last few years, where if they end up cutting rates when they should be hiking, your currency can fall 40%. So these are the risks you face. It's like the strength of institutions and the independence of central banks ultimately.
So perhaps putting emerging markets to one side, where should investors be thinking about safety, protection, or is it just not that simple?
Yeah, I mean, it's really not that simple. And, alluded to earlier as well, as even if you say US Treasuries, it depends which treasuries. And you could even say, is it inflation-linked treasuries or nominal treasuries? So it's a very, very difficult one to answer. But when people say safety, if they mean safety from some recession or crisis, then I do think short-dated US Treasuries surely will be the safe haven if you're looking at bonds, because as mentioned, the central bank in a massive liquidity shock will step in and do whatever it takes, and they've done that time and time again. And the Fed can cut rates to zero, and they did that only a few years ago. So there's a lot of precedent for this. But safety does not mean longer-dated Treasuries. And then when you think about currencies, traditionally the dollar used to do well in crises, but that is definitely coming under question. Then where do you go? Do you go to the Swiss franc? Well, that's been looking quite overvalued on a number of metrics, although I think still okay. The Japanese yen, well, if what you want protection from is inflation and higher interest rates, and absolutely not the Japanese yen, because it's likely the Bank of Japan won't be hiking as fast as other people will be hiking. So the yen will tend to do badly in an inflation shock, as we saw in 2022 and 2021. But I think very, very easy when you look at things like credit markets. I mean, clearly, the lower down you go in credit rating, the more equity-like your returns, and in a crisis, you will do less well.
And actually, Tim, how are you managing the portfolio at the moment, and things like the sort of tightness of credit spreads? How are you getting around that?
I mean, yes. So continue to be very, very cautious on credit. I mean, we saw a bit of, if you look at sort of US dollar and euro investment grade, and we had a bit of April for a few days, we widened out to something like, but even at the wides, only sort of the median sort of spread levels that we've seen in the last 20 years, and then we've rapidly tightened back to sort of 20th percentile or something like that in euros, and even inside that in dollars. So yeah, I think probably in the main, and certainly in lower rated credit, you're not really paid for the risk that you're taking, and that's a kind of fairly easy underweight. We have been adding a little bit of duration. We've talked a lot about currency position. We have been adding a little bit of duration in the last few weeks. Again, I think that makes sense. I think that the impact of this uncertainty is likely to be fairly negative for the US economy. Think that if the inflation does turn out to be sort of fairly contained and fairly sort of spread out, then that sort of gives the green light for rate cuts. And so yes, think it's appropriate to a small kind of overweight to duration is appropriate at this point.
And how are you thinking about balancing risks in your portfolio? Because I think what we've heard here is it's not a straight line here. There's no one sort of silver bullet to solve the challenges within the fixed income market. So how are you thinking about expressing your view, but perhaps where could you be wrong? How are you balancing those?
As a portfolio manager, what you're always looking for is asymmetry. It's where if I'm wrong, there's not too much downside, and if I'm right, there's a lot of upside. And as a long-term value investor, your starting point is valuations. That is your safety cushion. So, talking about credit earlier, where it may well be that if growth is a bit weak but not too weak, you don't get too many defaults, we could just carry on. And I tend to think that in the long term, technicals tend to be short-term factors that drive markets. But in the long term, the level of credit spreads is driven by where global growth goes. So if global growth, if we avoid a recession, then maybe you can justify credit spreads staying in or around these levels, and you do get paid to have a bit of carry. But the problem is that, as we discussed a lot already, there are many risks to this kind of just, very low volatility, everything's fine, the can gets constantly kicked scenario, and then lots of risk events coming up. And that's where I think credit, to me, is where there is little upside, but potentially a lot of downside if something goes wrong. And within fixed income, I want to allocate to where I think there's a lot of upside and not much downside. So we've already talked about emerging markets where valuations are already on the floor in many currencies and local currency government bonds. So it's not just actually currencies that we like, it's actually Andressa mentioned the nominal yields and the carry being high. I actually say it's the real yields which are attractive. Where in developed markets, we've got used to, in the last year or two, US Treasury yields being bigger than US inflation. You've got positive real yields or positive real interest rates, but it's only slightly positive. If you look at things like Brazil, another, I've mentioned Brazil for about the 5th time today, but Brazil, inflation has been kind of 5.5% range, and the nominal bond yields are at 14, interest rates are now at 15. That is enormous real yields. So people are looking around global fixed income for juice. And there's not much juice in developed market credit, and there's a huge amount of juice in emerging markets. So for me, that's the place to go.
Tim, we've talked about the advantages of short-dated debt, but what about cash at the moment?
I mean, cash is your ultimate sort of short-dated asset, and I think yes, you're talking about say safe havens. Particularly if you're a little bit concerned about the correlations with longer dated, governments, with cash, you've got zero correlation by default. Actually, you prefer it really if yields go up because you earn more. And 4.5%, dollar yield, looks pretty good to me compared to the alternatives. So I think cash is a strong contender there, both for defensive reasons and also because you get a reasonable return. And I think yields are not, barring a sort of severe recession, central banks are sort of sufficiently worried about the inflation impact, and they massively regret the long periods of zero rates. So it's hard to see, as I say, barring very extreme recessionary outcomes, it's hard to see yields going all the way back to zero. So.
Katie, we've covered a lot of ground here today. You came, you asked the question, you've heard some answers. What are your takeaways?
What's really clear is there has been a shift. We've talked a lot about things that were true over the last 10 to 15 years and are now changing at the margin, whether that's over the long term, whether that will be sustained. But I think what that means is investors need to think very carefully about what they have in their portfolios, what they're doing around where they sit on the curve, how they're thinking about duration, how they're thinking about their safe haven assets, and importantly, not to overlook asset classes like cash, which perhaps certainly prior to sort of 2021, 22 was not necessarily an asset class that you would think about within portfolios. So I think it's that, thinking, watching what happens over the coming weeks and months in bond markets and not taking your eye off the ball. It's like you can't look at a steady state as we go forward, at least for the time being. There's too much that may change, or indeed maybe nothing changes.
A steady state. Do you remember that? Also, I think like that point about fixed income not being a homogenous asset class that Mike made earlier. That's an important point that that investors should take home. Okay, well we're almost out of time, but before I let you go, we need to play this month's hot cakes and hot potatoes. What would you buy like a delicious hot cake, and what would you drop like a very hot potato? I'm going to come to Mike first.
Or it's been teed up or served up already very easily, but hot cake is emerging markets for me. In the portfolios I manage, I'm running a lot of EM risk, and I think that's where the opportunity is to make money, both capital gains and definitely where the income is at the moment. The hot potato for me, therefore, is the other side of this, which is credit. So, with credit spreads very tight, to me, very little upside. And really potentially a lot of downside if any of these volatility events do come to pass.
Of course. Okay, and how about you, Tim?
Well, so we've talked a lot about cash already. I do think that's a good thing to look at this point. Another hot cake. I quite like US inflation-linked bonds. Actually, probably not the very long end, but sort of 10-year, 2% real yield. I think over the long term, looks pretty attractive actually. So that would be my other after cash. That's probably my number 2 hot cake. Hot potatoes. I'm quite cautious on JGBs actually. So we talked a little bit earlier about the Bank of Japan, and I think their idea of the terminal rate is quite a lot higher than what the market currently has priced. They've got pretty sticky inflation there, and they're kind of the epicenter as well of the high government deficit. And the Bank of Japan are shrinking their balance sheet quite rapidly at the moment as well. So I think that's a good one to avoid.
Different story there. Thank you, Tim, and thank you, Mike. Well, and we've also got a little bit of time for a bit of culture. This is the moment in the recording where I ask the guests what have they been reading and watching. I'm going to start, Katie, with you.
So nothing to do with the fixed income market, I'm afraid, but I read a really interesting article recently in New Scientist that was all about mass extinctions. So the theory is we've had 5 historic mass extinctions through the last 4 billion years of the natural world. We may well be in the 6th one. This article was all around actually maybe those mass extinctions weren't indeed mass extinctions because not everything in its class or its type of creature actually went extinct. Somewhat controversial theory, but really, really interesting.
It's a less dark picture of the geological history, I suppose. And Tim?
I'm going to come out slightly weirdly similar to Katie, actually, because I have a 4-year-old and there's a new BBC series at the moment, but I've been absorbing a lot of dinosaur-related content recently, which is kind of interesting. But it lead me to sort of reflect a bit on the sort of unimaginable kind of lengths of sort of geological time, I suppose. And what is kind of new to me, but probably obvious to anyone who knows about this sort of topic, but how actually there's enough time there for multiple sort of cycles of kind of evolution and then specialization and then maybe sort of mass or not mass extinction events. You think about like something like an early sort of a Stegosaurus or something that's kind of more ancient to a T-Rex than a T-Rex is to us. It's sort of staggering.
That is an amazing thought, yes. And Mike, I know last time we had you in here, you were watching 80s movies. Are you still on that diet?
No, I've managed to move on a couple of decades. So, also with fairly small children, slightly older than Tim's, but I've got a huge backlog of films which friends have recommended to me that I should watch, which I'm working my way through. So I've got up to 2016. Keeping on the war theme that we mentioned earlier, but a film called War Dogs, which is a rather dark comedy, and essentially it's about how the US, for some bizarre reason, decided to just let people with minimal oversight just tender for supplying, let's say, 1 million bullets for wars in Iraq and Afghanistan. And I think this is probably just to get over the kind of the criticism where it had been a complete oligopoly or even monopoly in terms of who was benefiting from these wars. And inevitably I won't spoil it for anyone who wants to watch this film, which I do recommend, but it doesn't go quite as well as you would have hoped.
Just a surprise there. A wonderful, diverse selection. Thank you very much to all of you. And that really is all we have time for. So thank you to Katie Roberts for helping me grill our guests today. And thank you to our guests for taking the grilling. That's portfolio managers Mike Riddell and Tim Foster. And thank you also to our sovereign analyst, Andressa Tazine. You can find out more on the topics we've discussed today on your local Fidelity website or at fidelityinternational.com. If you've enjoyed today's episode, please share and subscribe. The producers today were Holly Eastman and Patrick Graham, with production support from Adam Sheldrake and Connor Bailey. For now, from all of us at Fidelity, goodbye.